let's review the dividend discount models that we studied for the stock valuation chapter. Remember, these are intrinsic valuation models, meaning that we're just looking at the subject companies, in this case dividends, future dividends that we can potentially forecast as a way to determine the value of the company's stock. So these are not comparable methods where we are looking at projected financial statements in comparison to an industry or competitors, but again, just intrinsic methods where we will value a company based off of either their anticipated dividends in the future or their free cash flows. So in this example, it says that Apple Company is looking to buy a banana company. Apple will investigate the value of Banana several different ways, including several dividend discount models. Banana's previous 5 years of dividends are below. So we have dividends from 2016, which was $1.25 that year, through 2020, which was 95 cents. There are many different growth assumptions that Apple will consider, but below are 3 specific alternatives that need to be solved for. The assumed cost of capital is 9%. So again, when we are valuing stock just based off of dividends, we are going to make a forecast determination for what the dividends could look like in the future, all the way out into forever, infinity, and then discount those potential cash flows back to the present, just like we would a bond. And a bond, though, obviously is more predictable because it has set coupon payments and it does have a maturity, so it's much easier to value the cash flow of a bond, given that its features do have that set dividend as well as some maturity. With stock, we are presented with the challenge of not having a set dividend. The dividend can fluctuate every year. It does typically fluctuate, and there is no maturity for a bond too. For a stock. Stock could theoretically live forever. So we do fortunately have some different ways that we can value stock based off just dividends, but we do need to apply some assumptions for how those dividends could change or grow out into the future. So the scenario is asking, what's the present value of Banana stock per share price for each of these 3 scenarios? In the first scenario, the dividends next year are expected to normalize, settling in at $1.75 and remain flat or unchanged at that $1.75 forever. So in this particular case, of the 3 different models that we looked at, this would be a case of zero growth. So the dividend is expected to stay flat and not grow next year or really any year thereafter. So we would value this just like we would a regular perpetuity. Regular perpetuity, those values are set as the cash flow divided by the required rate of return. So we take the cash flow that we're expecting from the perpetuity and just divide it by the required rate of return. So this is just really like a perpetuity in that we have a dividend that's not going to change, and we've got a required rate of return, in this case of 9%. So we could value this using the regular perpetuity formula by just taking that $1.75 and divided by our required rate of return, which was 9% in decimal form. In this case, we get $19.44 as the per share price or value of the stock. In the second model, we have dividends expected to be $1.75 next year, and then we're expecting that dividend to grow every year thereafter at 6%, and that growth would happen theoretically to infinity. So we have a model for this called the constant growth model or Gordon growth model, which accommodates this exact scenario where we're expecting dividends to grow each year and grow by the same percentage every single year. So it's important for this model that we are utilizing next year's dividend. In the regular perpetuity formula for the first alternative, we could essentially say the same thing, dividend of next year divided by required rate of return, but the dividend is the same this year, next year, and every year thereafter. So it's not quite as particular as far as how we label the numerator. With the constant growth model, we do need to make sure we're using next year's dividend in the numerator. Again, anytime we are determining the present value of something, we're determining technically the present value of a future dividend. So We would not use the most recent dividend because that's not a future value. So we're always going to use the next year's anticipated dividend, which in this case is given to us as $1.75. So we would have a $1.75, and then divided by the required rate minus the growth rate. That again is the constant growth model that we're introduced to with the stock valuation chapter. So in the denominator, we need to make sure we're grouping those two terms because there's subtraction involved. So based off of order of operations, we want to make sure that the mathematical operation is correct. So we group that required rate with parentheses minus the growth rate, so 0.09 minus 0.06. And we come up with a value of $58.33. Right, for the third alternative, we have dividends expected to be $1.75 next year. We are expecting them to grow for 2 years after that at the growth rate of the 2016 to 2019 dividend span there. And then we expect the dividends to grow in year 4 to forever at 6%. So we have several different things happening here. Again, next year the dividends are expected to be $1.75. They're going to grow for 2 years at maybe a higher rate, whatever that 2016-2019 growth rate was that we'll need to calculate. And then we're expecting a constant growth of 6% in year 4 to infinity. Now it says the 2020 dividend is considered an anomaly due to the pandemic and therefore not being used by Apple in determining Banana's historical dividend growth rate. So we're going to be using the 2016 to 2019 dividends that were paid out by the Banana Company to provide a reasonable idea of what the dividend growth rate has been historically, and then we'll apply that growth rate going forward for a couple of years. So first thing we need to do is figure out what that growth rate is, 2016 to 2019. So we can do that up here. By using the rate function. And remember that the present value is the earliest dividend. In this case, 2016 dividend was $1.25, and I'll put a negative on that because I'm going to have one figure be a negative and one a positive in order to avoid any error messages in Excel. Getting cash inflows, cash outflows doesn't necessarily apply in this case because these dividends would have been cash inflows to whoever received them. But again, just to get around any numerical errors in Excel, I do need to designate one as a negative. So the future value would be our most recent dividend. In this case, we're going to use $1.85 because we're basically ignoring the 2020 dividend due to the pandemic and the assumption that that dividend was low because of the financial performance caused by the global shutdown. Now, number of periods wise, we have in this case how many years of year-to-year growth, or how many times was there year-to-year growth within that time span? Well, we had 2016 to 2017, that's 1 year. 2017 to 2018, that's 2 years. And then 2018 to 2019, that's 3 years. So we have 3 years of or 3 periods of year-to-year growth. So we use 3 as our number of periods. And that gives us a growth rate of 14%. Now with these problems, there typically would be some decimal places here, but instead of using 13.96%, we're going to use a growth rate that's rounded to a whole number, just like we would in any other problem where the growth rate is given to us. So it's okay that this rounded it off for us. We're going to use 14% as the growth rate. All right, so what's happening here is, again, next year we're going to have, let's say in year 1, we will have a 175 dividend, and then we have 2 years of growth based off of that 14% growth rate that we just calculated. So we will have, in this case for year 2, $1.75 times 1.14. So we're going to gross up the 175 by 14% by multiplying it by 1.14. And then we've got our year 3 dividend is going to be the 1995. I'm going to just type in the numbers here. If I use cell references, certainly it would be a little bit more precise because Excel will will carry out the decimal places to many, many more places. But just so you can see the figures better, I'll just round off to 3 decimal places at this point. But I'm going to gross this number up by another 14%. So 1.14, in parentheses just to distinguish it a little bit. All right, and then we have, in the problem here, we've got 2 years again at that growth rate, 2016 to 2019 growth rate. So there's our 2 years here, here's 2 and 3. And then it says, starting in year 4 to forever, the growth rate will be 6%. So remember, we always need to have basically all the first stage years covered as far as our future forecasted dividends, plus the first year of what we would consider stage 2. Stage 2 is really just that period of time where we have constant growth. So the first year of stage 2, or where we have constant growth, is really begins in year 4. So in this case, I would take again, I'll just type out the numbers, 2.274, and I'll use, again, 3 decimal places, times the 1.06 constant growth rate. Okay, and just gonna make sure these are viewed all in the same number of decimal places, like so. And those are the dividends that we'll need to utilize for our evaluation model. So draw a little bit of a timeline here to just kind of help show what's happening. So we've got out here, this is time 0. We don't need to put a dividend there because we are forecasting future dividends, and that's what we will discount back to the present. So we'll have year 1 of 175. We have year 2, move the cursor out of the way here. Of 1995. All right, we have year 3, 2274. And finally year 4, when stage 2 starts, of $2.41. Okay, so remember, this years 1 through 3 is what we kind of consider stage 1, right? So this is where we have some variable, kind of abnormal, potentially growth during this period of time. And then we have, at some point, things kind of leveling off, and we would basically apply a constant growth. And that would be our stage 2. And that stage 2 would start, in this case, in year 4. So this is up through year 3. Year 4 is this segment here, and then on out into forever. So we have stage 2. And I oftentimes like to put kind of a dashed line just to separate the 2 stages. Okay, and stage 2, those start after year 3. So this is end of year 3 here. Stage 2 goes from that point on to forever. So we have now a couple different stages that we need to value back to the present. So in this first stage here, we've got years 1, 2, and 3. Let me get back on my drawing tool here. Okay. So we've got years 1, 2, and 3 that we can discount back to the present. And we can consider this to be a mixed stream because these 3 dividend amounts are all different. So this is really just a mixed stream. Okay, so we can do that in Excel by using the NPV function. Okay, so NPV function, the required rate of return is 9%. Our first value was 175. Second value of 1995. And our third value of 2.274. So what we would say here is the value of the stock that we would attribute towards the first stage, the first 3 years of the forecast is $5.04. That's the value of the stock based off of just those first 3 years of expected future dividends. Now we need to figure out what's the value of the stock that we could add to that. That would be based off of the stage 2 dividends, which would be anything after year 3. So year 4 on to forever, what would the value of the stock be that we could attribute towards that second stage? Well, we've got fortunately some different things that we can use to help us out here. We've got primarily the constant growth model, which again says that next year's dividend, the value of the stock, in this case, the value of the stock at the end of year 3, price or value of the stock at the end of year 3 would be equal to the next year's dividend. In this case, next year's dividend is the dividend for year 4. So I'll say dividend sub 4 divided by the required rate minus the growth rate for that stage. Okay, so if we were to explore the value of stage 2, the value of the stock at stage 2, we could walk ourselves out theoretically out into time, standing here at the end of year 3, and say, okay, well, the value or the price of the stock at the end of year 3 would have to be, based on the constant growth model, would have to be the next year's dividend, which would be the dividend of year 4, divided by the required rate minus the growth rate. So if we calculate that out, we already have dividend of year 4 as $2.41. And we know the required rate is 0.09. And the growth rate for stage 2, again, remember, is 6%. Okay. And if we multiply that out, we have again 2.41 divided by 0.03 is $80.33. Now again, this value, this price, is the price of the stock at the end of year 3. So what I want to do at this point, kind of the last step, is to take this lump sum and discount this back to the present. And I can do that using the present value function. So I could say here the present value, again, a required rate of 9%, 0.09. That future value was $80.33. And I'll put a negative on it just so that my present value displays as a positive. And how many years back am I going to discount that $80.33 back? Well, I'm going to discount it back 3 years because that was the value or price of the stock at the end of year 3. So you can discount that lump sum back 3 years and get $62.03. Now, so again, that 6203, that is the value of the stock that we can attribute towards stage 2 of our dividend forecast. I need to, as a very, very final step, take the stage 1 value and add the stage 2 value to get my final value of the stock. So in this case, based off of the third scenario where we have dividends growing at various rates over the time frame, we would say the value of the stock is $67.07.